The intention behind these two sessions is really to take you through the various sections of the Omni risk return. We know you're all busy, we know it's a lot, but we want to really sensitize you to the information being requested, to assist you in understanding the requirements and the rationale from the regulator, and to enable you to make robust submissions both to us so that we can make a consolidated FIA submission as well as to the regulator. While this might not be the most exciting session, regulation generally not always the most exciting of topics, we believe that it's a business imperative that members engage with this content and provide input. This isn't going away, it is going to happen. And this is your time now to really look at what's being asked of you and understand it and give us the necessary input. So by way of background, for anyone who is unfamiliar, and I thought everybody knew what the Omni conduct of business returns were, and I was humbled in the last week or two to discover that there were people who didn't know. And these are overarching returns that are expected of businesses so that the regulator can get a perspective on the various aspects of businesses. It's far more far-reaching than the previous compliance returns. And after the initial round of input on the Omni conduct of business returns, which I won't go into too much detail, the FSCA went back to the drawing board and they've come back with what is now the Omni risk return. And the idea is to collect comprehensive data on conduct risks, governance quality, operational resilience, institutional stability, and all of this across the whole financial services industry. And I think this is important because you might look at some of the questions and go, well, this isn't relevant to you. And it may well not be because you're a financial services provider and you're not an insurer or a bank. But they've tried to create the questions as generically as possible so that everyone can answer them and that they can collate and look at data from a holistic perspective. The return moves beyond traditional financial reporting and looks to examine how firms manage customer outcomes, compliance, and systemic risks. And while there's still a lot of information required, I think it's our view that these are far less onerous than what was expected in the Omni conduct of business return. We're not going to pretend that there isn't quite a bit of data that's going to be needed here, but it is definitely a substantial improvement for members than what was required in the previous version. What is important is that you're able to provide accurate and complete submissions, and the FSCA will ultimately use the data that you provide in these returns to assess the supervisory risk. So the lower the risk in your business, the less scrutiny that there will be, and the higher the risk and the higher the sort of identification of emerging issues, the more scrutiny that there'll be. And they're also looking to take this data and benchmark institutional performance of regulated entities. So this will also be looked at comprehensively over periods of time. So initially, it'll be very much a point of time submission, but as we go to year 2, year 3, year 4, the regulator will be able to look back and compare the data that's provided through each level of return. So the return looks for key data points that act as early signals of potential conduct risks, internal control or governance weaknesses, or institutional failure, and that will enable the FSCA to intervene timely and proactively before risks crystallize. Over time, the data will be used to benchmark businesses against their peers, building a comparative picture of risks across the financial sector and making it possible to identify outliers and emerging patterns. It will furthermore enable proportionate, consistent, and forward-looking regulatory and supervisory responses. And for us, this is very important. We really do believe that there needs to be a proportionate approach to regulation. So if a regulator can look at the data that you present and determine that you are low risk, the approach that they're going to take towards the supervision of your business is going to be far less intrusive than it will be for a business that they perceive to be higher risk. Where risks escalate, the data will be used to prioritize enforcement. So again, that ties into what I've already said. And it also ensures that matters with the greatest potential for customer detriment or systemic impact are addressed quickly and with efficiency. Insights from the return will also help inform regulatory policy development including assessing whether any of the existing regulatory frameworks and guidance remain relevant, appropriate, and in line with intended customer and market outcomes. So what is important to bear in mind in this first phase of the rollout is that there is data that will be used to create a risk profile of your business. And in phase 2, there'll be increased reporting requirements for those businesses deemed to be higher risk. The consultation period is running from the 1st of October to the 30th of November 2025. So there's a 2-month window. Obviously, we are already at the end of that first month period. So we now really have essentially 30 days left to compile and collate our feedback. And it's intended that the implementation of these returns will be aligned with the FSCA's integrated regulatory solution, which has an expected go-live date in 2026. And there'll be a pilot that'll be run before that implementation date. And we really do encourage all members to participate in that pilot. It'll give you a sense of how the returns operate practically. It will also give you a true real-time sense of you to be able to determine what you can and can't respond to. We're very, very pleased to advise that the reporting frequency has now been changed to annual. With the Omni conduct of business returns, the regulator had proposed quarterly reporting, which was exceptionally onerous. So this is a real improvement, but that annual requirement will be subject to ongoing review and may be adjusted over time as the risk model evolves and the FSCA refines its supervisory approach as this project progresses. So notwithstanding all of this, it is expected that this will be rolled out incrementally across the various sectors in the industry, and this will form part of further industry consultation in the future. So just before we get into the detail of the various sections of the return, I think some things that are very important, both in terms of what Brad and I are going to go through in the 2 sessions, but when you are looking at the requirements yourself. What the FSCA is primarily looking for input on is whether and to what extent the data requested is available within your organization. And I'm going to come a little bit during the sections to just the simple response of, no, I don't have it. Also, whether the data is currently being collected and maintained, and whether you're able to extract and report on that information in the manner being requested. And then also, if the data isn't yet being collected, an indication of how much time you would need to be able to get your business ready to report on that data, or alternatively, what data you might have in your business that is currently available to adequately meet the objectives of the particular section. From our perspective as the FIA, we also think it's very important that when you're looking at this and you're listening to what we tell you today, do you understand what's being asked of you? How easy or difficult would it be for you to get this information? Do you envisage any costs that you would need to take into account to actually obtain the data or develop systems to support obtaining and providing the data? Are there any specific definitions or terminology that require clarification? And are there potential situations where the information requested may not be available or known to you? So, for example, where product providers do not notify intermediaries of client-initiated changes. That's just an example. I'll give you some insights into the FSCA's views around that when we come to those sections. But those are things I think you want to have top of mind when you're working through this. There are 12 sections of the Omni risk return, and each section is designed to capture a distinct dimension of a financial institution's operating environment, governance arrangements, and risk exposures in a standardized format. So our webinars are split into 2 sessions. This first one, as I've said, covers sections 1 to 6, and the second covers sections 7 to 12. I mentioned up front, but for anybody who joined a little bit later, there is a Q&A functionality available, and we'll aim to address a few questions at the end if there's time. However, if not, we've created a dedicated email address to which members can submit queries, and we'll provide more information on that at the end of the session. And as I've mentioned, the recordings of the 2 sessions will be made available to members. So Before we move on to the specific sections, just as a general note, if you're not an accountable institution, you're not required to provide responses to the sections that relate to accountable institutions. The same also relates to sections that relate to credit providers and market infrastructures. If you're none of those things, if you're purely an FSP, all you need to do is answer as an FSP. Be mindful if you have multiple FSPs in your group, each FSP will be required to submit a return. You don't submit on a consolidated basis. It is on an entity by entity basis. We did ask the FSCA whether when the actual returns become available, you'll only see sections that are applicable to your business during that pilot. But they weren't able to provide a clear response at this time, although they said they may have answers to that question during their own sessions. So just look out for that feedback from them. And again, I'll just reiterate, as we go through the return and as you go through the returns yourselves, if there's anything that doesn't make sense to you, you should specify this in your response. It's not sufficient to simply say that the requirements are overly onerous. We all know how burdensome regulation is. We actually have to be specific. What is the issue? Why might you not be able to present it or provide it to the regulator? So we're going to, we've broken down our feedback to you into sections. So what is the purpose or what is the object of what the regulator is trying to achieve in the section? What might you need to think about as a business? And these are comments you might not necessarily be required to provide it in the return, but it should assist you in completing the returns and may support any further information requests from the regulator. And we've also highlighted what may be perceived as red flags from the FSCA. So these are all just things to think about. And without further ado, if I can take over the sharing of the screen, team, I would appreciate that greatly. And I am doing that. And Brad, you can just let me know whether my screen is visible.
100%, Sam. We can see it.
Fantastic. So now we're going to get into the nitty-gritty. The first tab on the spreadsheet relates to terminology, and we're not going to go through this in any specific detail. But what we really suggest that you do as part of your review is you consider whether these definitions make sense, and also if there's any terminology that's contained in any of the other sections that's not defined and which you believe require clarity, highlight that, indicate that. So for example, when we get, and I believe it's to section 5, the term assets under management hasn't been defined. That might be an issue. If it's the regulated definition of assets under management, that's great. But if it's not, you know, should there be a definition included here? So have a look through this, see if there's anything that you think is missing, or if you don't understand the definition as it's provided and exactly what's expected of you. I'm now going to move on to section 1. Probably, I would say, the simplest and easiest section of the return. Well, hopefully, if not, I think we've got bigger problems. You'll note in this section that what they're looking at is group structure and ownership and shared services. And all information and all monetary values that you put in this section, you'll need to put in as South African Rand denomination and using the prevailing conversion rate at the date specified in the return. And the purpose behind this section is to really establish the organizational structure, ownership linkages and dependencies, and assess governance complexity and ownership and control and accountability, and identify potential contagion or oversight risks. So the more complicated your business, the more difficult this section is going to be to complete. The more simple your business is, all you have is a sole proprietor or a 2 or 3 man business, and that you don't have complicated ownership structures, the simpler this will be to complete. So moving on to subsection 1, which is group structure. And the objective of this is that the regulator is aiming to establish whether the institution operates standalone or as part of a group, and to identify the parent entity and jurisdiction. And this supports an understanding of organizational complexity, ownership or control and accountability, And it highlights potential contagion or oversight risks in complex or foreign domicile groups. Now, we know we don't have masses of those within our membership base, but we do have some of them. And so these are important things. So we know that lots of category 1 and category 2 FSPs are part of larger financial conglomerates or insurance groups. And so you might need to bear this in mind when you're completing this return. You need to be able to clearly distinguish between your regulated financial services businesses and your unregulated entities. We also suggest that you document the legal relationship in your group where applicable to easily be able to provide this information if you do not already have this readily available. Because although the questions asked here are simple, as I mentioned up front, there may be requests from the regulator based on what is provided here for you to provide more information. And the more easily and accessible this is, the easier it is for you to respond. As I've noted above, we also have many small members who are not part of a group. So this section should be very simple to complete. You would simply state, this institution does not form part of an organizational group. It's worth bearing in mind that the following red flags may raise for the regulator depending on the type of responses that you give. So unclear ownership chains may suggest a lack of transparency of ownership. And this is important from an anti-money laundering perspective. Foreign parents in low regulation jurisdictions may also present a risk, as well as multiple layers of ownership and ultimate beneficial, which would obscure the ultimate beneficial ownership of a business. Just to note, you'll see in column C, under the primary jurisdiction of the parent entity of the organizational group, they've reflected Angola there. That is purely an example, and you would need to input your own data in that column. Moving on to section 1.2, subsection 1.2, this deals with intergroup financial transactions and shared services. And the objective of this is to determine the extent of reliance on intergroup financial flows and shared services. It'll highlight where there are intergroup dependencies, related party exposures, and structural complexities. And a high reliance may create concentration risks or vulnerabilities if group support is withdrawn. So the simpler your business, again, the easier this is to respond to, and the more complex your business is, the more challenging it will be. But we do know that a lot of smaller financial services providers rely heavily on group infrastructure for IT, compliance, risk management, HR, audit, and it would be good to document these relationships transparently with clear contractual arrangements, as well as to define shared services with SLAs and dispute resolution mechanisms. And as I say, while this information isn't specifically being requested at this stage, this type of information may be requested by the regulator in future, dependent on the responses provided. And again, things that could raise scrutiny from the regulator would be excessive reliance on group funding, which may indicate sustainability concerns, a high concentration of shared services in a single group entity, and also evidence of cross-subsidization that would potentially mask true business profitability. Finally, in terms of section 1.3, this really relates to the benefit, the nationality of the beneficial owner of the entity. And the purpose is to identify links between beneficial owners and Financial Action Task Force or FATF high-risk jurisdictions, as such links could indicate elevated anti-money laundering or counter-financing terrorism risk exposure. So this is particularly relevant and important if you have a foreign beneficial owner, as the FIA is concerned about FATF alignment and whether governance reflects international anti-money laundering controls and standards. And while foreign ownership doesn't automatically trigger concerns, a lack of transparency does. So a red flag for the regulator might be beneficial owners in FATF grey listed or high-risk jurisdictions, beneficial ownership structures that obscure true control, as well as beneficial owners with reputational risks or links to sanctions listed entities. But in short, it's a fairly short, straightforward section. We hope that this information is readily available to you. Again, if it's not, please do let us know. We're now going to move on to section 2, and I'm going to hand over to my esteemed colleague, Brad. Brad, over to you, if it'll move. There we go.
Awesome. Thank you, Sam, for setting the scene and kicking things off. Just from my side again, afternoon members based all over the country and obviously representing various disciplines. So with regard to section 2 of the return, this really relates to the geographical presence of the FSP who's completing the return. The purpose of this section really is to map out the operational footprint and cross-border exposures, and to enable the assessment by the FSCA of any geopolitical risk, regulatory arbitrage, and any operational complexity of the FSP in question. As you can see, the section is also split between financial services businesses and non-financial services businesses. So with regard to question 2.1 and its relation to jurisdictions, this particular question is designed to determine your business's operational footprint. It enables the assessment, again, by the FSCA of cross-border complexity and any geopolitical risk exposures, as well as provides an oversight of operations in jurisdictions with weaker frameworks or on high-risk watch lists, which, as you can expect, increase conduct and anti-money laundering and combating the financing of terrorism risks, or AML and CFT, as we will refer to them going forward. So whilst most Category 1 and Category 2 FSPs operate primarily in South Africa, they may have customer exposures in the Southern African Development Community, that's SADC, or other African jurisdictions. And just something to bear in mind, unlicensed jurisdictional presence presents governance concerns. By way of example, this could be non-financial services related business. Areas of concern for the FSCA may be relating to operations in jurisdictions with weak regulatory frameworks or weak AML and CFT compliance. The FSCA will also be looking at sudden expansion into new jurisdictions, as well as significant customer concentrations in high risks jurisdictions. Moving on to question 2.2 of this particular section, this really speaks to physical locations of your business premises. This question is designed to assess the scale and distribution of physical presence of your business. The reality here is that a larger footprint correlates with greater operational complexity and higher inherent risks. So sudden reductions may signal to the FSCA financial distress. Potential red flags for the FSCA could include a rapid expansion, which may suggest to the FSCA inadequate back office support. The regulator will also be looking at branches in high crime areas, as well as an over-reliance on a single location, which could suggest business continuity vulnerabilities. Just a note on question 2.3 on this particular slide, the additional information on jurisdictions. The inclusion of Bangladesh is purely an example, just like the Angola example in SAM's section 1. Here, you will just need to list all the countries in which your FSP has a legal or operational presence. That's it for section 2, Sam. Back to you for section 3.
Thanks, Brad. A short and sweet section. Moving over swiftly to section 3. Sorry, my sections are not moving. There you go. Wonderful. Okay, so this is where the more granular detail starts to come into play. And this section particularly deals with governance. Again, as in section 1, all monetary values need to be recorded in South African rands and using the prevailing conversion rate at the date of the return. And the purpose of this section is to assess the governing body quality, remuneration frameworks, risk culture, and compliance remediation as core drivers of conduct outcomes. I think a point to note here, and this is something we have raised with the regulator previously, as while the section makes reference to a governing body, we recognize that smaller businesses don't, and sole proprietors don't have governing bodies per se. So without a governing body, you would answer this question as other in 3.1, and then you would provide an explanation of your business structure so that there wouldn't be that expectation of a governing body. So 3.1 covers diversity and composition of your governing body, and it's designed to assess the governing body's independence, diversity, and expertise, And again, the level of scrutiny and the proportionality in which the regulator will look at this will be very much dependent on the size of your business. A one-man business versus a 500-man business are going to have very, very different levels of scrutiny from the regulator in relation to these type of questions. So a low proportion of independent members would potentially increase conflict of interest risk, while greater diversity supports better decision-making and transformation objectives. So the section specifically looks at independence, race, gender, and skills. And things that you as members may want to look at is that where you've got smaller boards, so for example, 3 to 7 members, which makes diversity challenging. The FSCA does still expect to see a proportional representation as far as possible to demonstrate your commitment to transformation objectives. And just to tie it back to Kofi, just remember that when we get to that point and we're looking at relicensing and the like, you're going to have to put your transformation plans in place. So this is a point to already start to think about. Where applicable, independence is really important. So at least one independent director is best practice if you're in that sort of framework. And board experience should span financial services. So there should be a mix of risk management, compliance, customer centricity. And again, as I've said, a proportionate approach is going to be taken in respect of smaller businesses. So you'll see here, we've got questions on race, and we've got questions on skills. So where appropriate, the information that may raise concerns for the FSCA are boards dominated by a single individual, a lack of skills representation. So for example, if you're a larger entity and you don't have any compliance expertise on your board, that may raise a flag. A high director turnover would suggest governance instability, and a lack of demographic diversity, also inconsistent with employment equity targets. Just jumping back up into the first section on this question about independent office bearers and non-independent office bearers, we did ask the regulator, and you'll see I've highlighted both on this sheet and some of the others, the FSCA to clarify exactly who they were looking for in relation to these sections. And they said they have included some catch-alls. So if you're unsure about who you believe will be covered in there that isn't already covered, do raise those questions in your feedback and input. Subsection 3.2 deals with performance and incentive framework. And this is to assess whether remuneration practices support fair customer outcomes or incentivize excessive risk-taking. So very low fixed to variable ratios may indicate over-reliance on performance-based remuneration. Obviously, we recognize that FSPs specifically work on commission, so that needs to be taken into account. But also sales volume-driven incentives increase conduct risk. So as you can see, the FSCA is looking to determine whether or not remuneration is based on qualitative or non-qualitative measures. And just for clarity and to ensure that everybody understands what that is, so qualitative measures are specifically relating to quality of work, as well as to, amongst other things, adherence to company values, compliance with ethical standards and professional development or mentoring contributions, as opposed to quantity. So we want members to be mindful that sales volume-driven commission structures are deemed high risk from a conduct perspective, and businesses are expected to balance revenue targets with conduct or customer outcome metrics. Management incentives should also reflect risk management, compliance, and customer satisfaction outcomes. So really, things that would jump out to the regulator that might have them knocking on your door would be extremely high variable to fixed ratios, which might suggest over-reliance on performance pay, absence of conduct or customer outcome metrics and bonus schemes, and commission structures that incentivize unsuitable sales. Subsection 3.3 deals with your risk tolerance levels. So this relates to the business's exposure to non-compliance incidents against board-approved tolerance levels. A high ratio of incidents, especially beyond thresholds, would signal governance weaknesses. So even small businesses should have documented risk appetite statements that include conduct and compliance tolerance. And nobody's expecting zero tolerance. That's totally unrealistic. What's more important is how quickly and effectively you remediate. And tracking mechanisms should enable both you and or your board to visibly see emerging patterns and to take action where those patterns are emerging. Again, so things that might result in further regulatory scrutiny could be an absence of defined tolerance levels, a high ratio of incidents exceeding your tolerance thresholds, and a pattern of repeat incidents in the same area, which would potentially suggest systemic control failure. And subsection 3.4 deals with the remediation of those non-compliance incidents and to determine how quickly those non-compliance issues are remediated, because persistent delays really do signal poor conduct culture or inadequate compliance capacity. And the FIA care less about you having incidents. Everybody has incidents. Nobody is perfect, but it's about how quickly and effectively you fix them. Slow remediation would signal poor compliance and weak governance culture, and root cause analysis. Your root cause analysis should move beyond training to identify systemic control gaps and look to how you can make improvements in your business. So really making sure that within your business, and again, this is not being asked for here, but it will support you in providing this data, is making sure that you've got documentation in place that maintains your audit trail of incidents, your investigations, your remediations, and the preventative actions that you take in. So the regulator would look at a high ratio of open or unresolved items, persistent delays in remediation, as well as repeated remediation of the same issue, which would suggest ineffective root cause analysis. And then finally, for this section, subsection 3.5 deals with insurance and guarantee claims, and it seeks to assess exposure to professional liability, cyber liability, and non-insurable risks, and the adequacy of risk transfer arrangements. And frequent claims may point to weak controls or poor ethical culture, and insufficient insurance would heighten supervisory concerns. So again, matters to keep in mind when we're looking at this section and thinking about your businesses and how you can meet these obligations. You need to make sure that you have your professional indemnity insurance in place. It's a not negotiable for financial services providers. And we do know, we as the FIA are absolutely mindful of the challenges that some of our smaller members are having in obtaining PI cover. And if this is the case, please reach out to our membership team to obtain more information in relation to the FIA's PI scheme. They're waiting to take your call. Cyber liability insurance also reflects awareness of digital risk. South Africa is at hugely high risk of cyber attack. So making sure that you've got the right level of cyber protection in place is vital. And this isn't only important for you, but it's important for your clients. And again, obviously, your pattern of claims would potentially reveal systemic issues, and repeated claims, again, would signal process gaps. So the regulator would be particularly alarmed by insufficient or no professional indemnity insurance, multiple claims in the same product area or service area, a high proportion of claims settled as opposed to contested, which suggests you're admitting liability, and obviously that's an indication of control failures. And if you don't have any cyber claims, in spite of having a material IT infrastructure in your business, it would potentially suggest underinsurance. I'm now going to hand over to Brad to cover section 4, the nature of customer base and politically exposed persons or PEPs. Brad, over to you.
Awesome. Thank you, colleague. So section 4 of the return really speaks to the nature of your customer base and politically exposed persons, otherwise known as PEPs. So the purpose of this specific section, Sam, I'm not too sure if it's stuck. If you could scroll up, please. Awesome. Thank you very much. So again, yeah, the purpose of this section is to really profile your customer base, assess conduct vulnerabilities and market concentration, and to identify any AML and CFT risks that your business may have. So subsection 4.1 speaks to the number of customers per legal entity type. So just to clarify, this subsection looks at companies, trusts, partnerships, etc., retail clients are dealt with below in section 4.2. So what is the purpose here? Again, it's to assess the composition and economic scale of your own customer base. A larger or higher turnover customers pose a greater AML and CFT risk, and different entity types have different sophistication levels and vulnerability to mis-selling. So in general, category 1 and category 2 FSPs typically serve high volumes of low value customers. Oops, Sam, see it back. So here we're talking about retail or natural persons and SMEs. This is actually a conduct strength if processes are designed for mass market efficiency. Conversely, conduct risks increase if you serve low income or unsophisticated customers without appropriate protections. Sudden shifts in customer composition may signal strategic repositioning, which would be a lower risk, or client loss, which would be deemed a higher risk. In terms of what the FSCA may consider, a very high customer concentration in a single segment, as this may suggest a narrow market focus. Furthermore, a declining customer base may suggest loss of market share or reputational issues. With regard to subsection 4.2 on the specific sheet, this requires information around natural persons and their income or affluence and PEP status. I think now this is really important, so members just need to pay a bit of extra or careful attention here. The FSCA have indicated to Sam and I that an inability to provide the customer segmentation data will be deemed a red flag. Their view is that this information, that this information should be obtained as part of your needs analysis with the client. Why? Because this information should have been discussed or raised as part of the financial advice that you would have provided to your clients. This is just a lens to keep in mind here. I do want to highlight that this section requires substantially less information than had previously been required in the Omni Conduct of Business Return, or as it was known as Omni CBR. So we're dealing with the risk return now. The previous iteration was Omni CBR. So what is the purpose of this section again? It's really to segment customers by income or affluence and their PEP status. A high proportion of low income customers increases conduct risks, as well as the fact that PEPs present increased AML and CFT and reputational risk requiring enhanced due diligence. Just a reminder, as Sam stated, for this particular section, section 4.2b, it's another example of the return that is only to be answered by accountable institutions. However, some points for members to consider with regard to section 4.2, while most intermediaries serve predominantly non-PEP retail customers, if you do serve PEPs, your due diligence must exceed standard Know Your Client or KYC. Documented enhanced due diligence is absolutely essential in this regard. PEPs include senior government officials, their family members, politically exposed person as per the FATF definition, etc. Beneficial owner PEPs are particularly high risk in this regard. An example of a red flag that the FSCA will particularly monitor in this regard is where there's a high number of PEP clients. Scrolling down to section 4.3, this really speaks to your total number of customers. Right, so the purpose of this section is really to determine the scale and reach. A large customer base increases systemic impact and potential for widespread harm. Conversely, low or declining numbers signal to the FSCA sustainable risks. This section also provides the denominator for complaints rates and other ratios that the FSCA will be looking at over a period of time. So a declining customer base may also very well signal reputational damage, competitive loss, or strategic retreats. These are things for members to bear in mind when you are completing the specific section. A few red flags in terms of what the FSCA will particularly be keeping an eye out for. This includes rapid customer growth, an unexplained decline in customer base, which could signal a potential reputational issue or exit strategy, as well as the inability to precisely count active customers, which would suggest or could suggest poor customer data management on the part of the FSP, I beg your pardon. So subsection 4.4 at the bottom of the sheet pertains to customers and their ultimate beneficial owners from grey and blacklisted countries. Again, this is another section that is only to be completed by accountable institutions or AIs and is designed to measure exposure to high-risk jurisdictions. Customers or ultimate beneficial owners or UBOs, as we will refer to them, from blacklisted or grey-listed countries significantly increase AML and CFT risks and attract closer scrutiny by the FSCA. Some key points for members to bear in mind with regard to this specific section. This is a high-risk area for AML and CFT perspective, from an AML or CFT perspective, I beg your pardon. Even though South Africa has recently been removed off the grey list that took place late last week, the fact of grey listing of South Africa has heightened the FSCA's focus on this metric specifically. So members really need to be conscious of this. Customers from high-risk jurisdictions require enhanced due diligence and ongoing transaction monitoring. UBO connections are as important as customer nationality. In terms of what the FSCA would also be particularly interested in is that where there are instances where any customers from FATF blacklisted countries should be near zero, and that significant exposure to grey listed country customers or UBOs would heighten this risk. Sam, that's it for section 4. Over to you for section 5.
Awesome. Thanks, Brad. I've been having a quiet laugh to myself because with the advent of AI, I'm wondering when there will be the confusion around whether it's your artificial intelligence that will be answering or you or your accountable institution.
Fair points.
I'd only just thought of it as I was listening to you there. So yeah, it'll be interesting to see. But for now, it is accountable institution.
Sam, can we be naughty and please kindly suggest and ask members please to not use ChatGPT to complete these forms?
Yes, please.
Please.
We really need independent, original thought. AI does not know your business, does not know the issues in your business, does not know what data you do or don't hold, or how easy or otherwise this will be to respond to. So awesome point, Brad. Thanks. Appreciate that. Now moving on to section 5. I might even lose my voice as I go through it. It is a very, very long section and specifically deals with the handling of customer assets. Again, any monetary values must be reflected in South African rands and reflected in the prevailing conversion rate where relevant. And the purpose of this section is to assess the scale and security of customer assets held or managed. And I think held or managed is quite an important point here, to identify operational and anti-money laundering risks in asset movement, allocation, and tracking. Now, we did raise a question, and why I've highlighted this in yellow is we did raise a question with the FSCA as to whether section 5.1 relates to client money and premium collection. And client money, the Cat 2s on this webinar will know what I'm talking about, and premium collection. And the FSCA indicated this section includes the value of assets in respect of which you provide advice. And but on further sort of interrogation, they weren't entirely sure. But they said that the word held or managed covered that. But again, this is something that they will further confirm, and they did indicate that it was something that they would discuss in their webinars. So subsection 5.1, assets held or managed on behalf of customers, is included to determine the scale of fiduciary responsibility within a business. So the higher asset values, the greater potential for widespread harm if mismanaged, and significant declines might indicate a loss of customer confidence or reputational issues. So for intermediaries managing material assets under management, operational risk is deemed significant, and a decline in assets under management may signal customer loss due to poor performance or reputational issues. Third-party custody also introduces operational and counterparty risks. And as those of you who collect premium know, where there was all the excitement some years ago around IGM, and then the reaction from the regulator to initially suggest that premium collection no longer be permitted, they then introduced the regulations which allowed for premiums also to be collected directly into insurer bank account, which they deem to be of less risk than using a third party or collecting into the FSP's bank account. So information that could raise questions for the regulator would be a high decline in assets under management, inadequate insurance or indemnity coverage. And I think this is actually quite an important point, because While you're going through these sections, remember that the regulator will be looking at this holistically. They're not going to just look at section 4 without considering the information that you put in sections 1, 2, 3, and 4. It will be all looked at as a holistic picture of your business. And then also concentration of assets under management with a single custodian in relation to our CAT 2 members. Subsection 5.2 deals with the collection of money and payments. And this section is designed to assess how customer funds are collected, so direct versus third party, and whether any foreign entities are involved. Third party collectors, particularly cross-border, introduce operational and money laundering risks. So again, here we have highlighted the points in yellow, FSPs excluding entities in categories 1 to 4 and representatives of financial institutions that are not listed in categories 1 to 6. And we queried who the regulator envisaged being covered in these sections. And they indicated that they had included some of these things as a catch-all, as we indicated in the previous section. So I think certainly worth highlighting that they should provide guidance on who they're anticipating would fall within these sections. Again, some considerations for members. Third-party collection introduces that operational risk, and cross-border collections amplify money laundering and counter-financing terrorism risks. So for the regulator, a high proportion of cross-border collections as well as reliance on informal collectors might indicate money laundering risk. Section 5.3 deals with the allocation of assets received, and this is to evaluate whether customer funds are allocated in a timely manner by measuring time to allocation. Highly delayed allocations suggest weak systems and a lack of capacity or poor governance. And please just note that in relation to this section, only fully allocated transactions should be reported on in question A. As you're aware, there are prescribed timeframes within which customer funds need to be paid over where you're collecting premium, and delayed allocation of customer funds is both a conduct issue, which could result in customer detriment, and an operational risk indicator. Funds held pending allocation are exposed to operational risk, so that could be theft or misuse, as well as creating cash flow timing concerns. Also, delays signal weak systems or inadequate capacity. And from a money laundering perspective, delayed allocation can also facilitate layering or structuring. So those are potentially things that the regulator would be looking at, as well as a high proportion of funds not allocated within 5 business days, a material value of aged pending allocations, unexplained delays, which would suggest governance failure, and a pattern of monthly allocation delays. So these are all things that would really sort of suggest red flags for the regulator. Now, sections 5.4 and 5.5, you can see I've highlighted them in green there. These are both only to be answered by accountable institutions, but I think these sections are, and particularly 5.4, and I'm going to come into the detail now, are very noteworthy. The purpose is to monitor flows from border and metro areas presenting heightened money laundering risks, and disproportionate flows highlight increased exposure. So border areas present heightened anti-money laundering and counter-financing terrorism risks, so cash smuggling, informal cross-border flows, and metro areas may have informal sector activity with limited know your customer infrastructure. So this would mean that disproportionate flows from these areas warrant investigation. And the section is intended to help identify geographic concentration of higher risk customers. And so we've really highlighted this as this may well be data that you don't hold. I mean, the total value of money received from financial customers residing near a border within 100 kilometers, the total value of payments made to financial customers residing near a border within 100 kilometers. So do you have that data? If you don't, this is the kind of thing that you need to be commenting on. The regulator suggests that in terms of the legislation, you are required to geolocate your customers. But do you have this readily available? And a question I raised, because I just wanted to be difficult with the regulator, was, well, depending on from where I am, they're 120 kilometers. And from another angle, they're only 60 kilometers. I'm going to take the path of least resistance. So I think there's a lot of clarity that is needed around here. We need to get a sense of how much of the industry actually already has this data and how readily available it is without you manually going to do distance checks of your customer addresses against those borders. The FSCA would take particular note of disproportionately high values of border transactions, informal sector customers from border metro areas with limited know your customer documentation, cash deposits from border areas, and patterns of small transactions which would sort of indicate potential structuring originating from cross-border areas. As I noted, Section 5.5 also only to be completed by accountable institutions, and it's aimed, it deals with geopolitical money transfers, and it's aimed to measure the extent of exposure to high-risk jurisdictions through fund flows, and significant volumes would flag money laundering or sanctions evasion risks. Significant outflows to grey-listed or high-risk jurisdictions would absolutely attract FSCA scrutiny. And as Brad mentioned, although we are off the grey list, we have another FATF visit coming in 2027, and we could go back on just as quickly as we did before. So it's imperative that we as South Africans are making sure that we adhere to the anti-money laundering legislation and do the reporting that we need to do, because FATF is expecting the regulator to take action against those entities that do not comply. Material fund flows to or from FATF blacklisted countries and significant flows to grey-listed countries would also be something that would raise the hackles and concern of the regulator. Section 5, subsection 5.6 deals with unclaimed assets, and this obviously particularly relates to the number and value and age of unclaimed assets. So high or increasing levels point to weak customer engagement, poor governance, or inadequate tracing mechanisms. And we envisage that the FSCA will be monitoring a high ratio of unclaimed assets to your total customer base, which would suggest a disconnection between you and your client, growing unclaimed asset balances year on year. So this would indicate worsening engagement, a lack of proactive tracing procedures, and an inability to account for or reconcile unclaimed assets. So again, this is an important one, and one that we do expect that the FSA will be looking at. As you're aware, there is a big project around unclaimed assets and what to do with those. So we know that'll be a focus area for the regulator. Section 5.7, another one only to be answered by accountable institutions, deals with transactions by product class and offshore transactions, and it's designed to assess exposure to complex or higher risk products such as crypto, derivatives, and forex. And higher exposures increase inherent risks, and large offshore flows highlight jurisdictional or anti-money laundering or counter-financing terrorism concerns. So again, things that the regulator would look at would be material exposure to derivatives or forex, significant offshore transaction exposure, crypto transactions without clear regulatory or money laundering procedures, a high proportion of complex products sold to retail customers, which would indicate a suitability concern. And then finally, in relation to this section, subsection 5.8 deals with arrear retirement fund contribution. So again, this would be only relevant if you're operating in this space. And if you're not, you would not need to be dealing with this section. So the purpose is to measure arrears and assess whether retirement funds receive contributions in a timely manner, and high arrears would signal employer non-compliance or weak enforcement, and longer overdue periods would signal material non-compliance. So again, the FSCA will potentially see the following as red flags: material and growing arrear balances, extended arrears without documented recovery efforts, and an inability to enforce arrear recovery against employers. And now I've nearly lost my voice. I'm going to hand over to Brad for our final section 6. Over to you, Brad.
Thank you, Samantha Williams. Ending off today's session with section 6 of the return. So this really relates to transaction volumes, distribution channels, and composition of your business. So the intention behind this section is really to assess the risks associated with product distribution channels and transaction volumes, and to evaluate operational reliance on specific distribution methods of the FSP who's completing the return. So subsection 6.1 relates to transaction volume per distribution channel. So this subsection is intended to assess risk from how products are sold or how services are provided. Some channels, for example, such as online advice platforms, present higher risks. The information helps determine operational reliance on specific methods. In this instance, the FSA will monitor items or areas such as any rapid growth in a specific channel, as well as any channel concentration risk. With regard to subsection 6.2, this relates to transaction volume data. Again, Sam highlighted it earlier on, and I just need to reiterate. This is an example where members do not need to complete it, this section, if you are neither a financial market infrastructure or FMI or credit rating agency. So Sam, could you scroll down a bit, please? Thank you very much. That being said, with regard to subsection 6.2, the purpose of this information is really for the FSCA to track the scale of transactions facilitated by market infrastructures. High activity increases the importance of effective controls, as you can expect. So any larger credit rating agencies warrant closer scrutiny due to the systemic impact of errors. So again, if your business or if you aren't an FMI or credit rating agency, you do not need to worry about section 6.2. Question 6.3 is around distribution composition. All right, now just bear in mind that the return, as Sam stated, is designed for different types of financial institutions. You will need to answer as an individual FSP. So just to remind members here, you are answering this return on an FSP by FSP basis. If you've got X amount of FSPs, each FSP has to complete its own return. The aim is to understand the nature, or for the FSCA to understand the nature, structure, and size of your distribution force. Tracking intermediaries provides insight into conflicts of interest, oversight effectiveness, as well as future strategy risks. By way of example, and so as to not to belabor the point, if you are a sole proprietor or a small FSP with a rep, for example, you would answer as a single FSP with the one rep. Here, the FSCA will be looking at large intermediary networks, as well as a high turnover of intermediaries. And finally, by way of clarification, all of these are possibilities that may raise red flags in the eyes of the regulator, but they are not definitive. It will always be in the context of the broader information provided by yourselves across the entire return. So really, the FSCA / the regulator will be looking at the return or the data that you provide across the entire return. Members, and that includes our session on sections 1 through to 6 of the return. I'll now hand over to Sam to take us home.
Thank you so much. Thank you so much, Brad. I really appreciate it. And as Brad said, that brings us to the end of our first session. We will have a look and take the opportunity to look at the Q&A. Brad, I'm not sure if there's anything pressing there for
Sam, I've been rocking and rolling.
Address at the moment.
Nothing that particularly jumps out, Sam. I think members have really, from the Q&A, from the questions I've been answering, have been applying their minds in terms of, does the FSCA mean this? What do they actually mean? So these are the type of examples, the type of comments we'd like in terms of requesting clarity around the FSCA in terms of, what exactly does assets under management mean, which you've highlighted anyways.
Yeah. Okay.
So it's looking good.
Fantastic. Wonderful. Thank you, Brad. And I appreciate that. And I appreciate the questions from members. So we really appreciate you taking the time to join us today and hope this has provided some useful insights into the first 6 sections of the return. From a housekeeping perspective, we as the FIA have created a template for you to submit your feedback to us so that we can consolidate our member feedback and make a robust submission. And that feedback can be sent through to Brad and we're going to show it to you just now. We've created a dedicated email address to deal with any queries you may have, but to also send us your submissions. And that needs to be sent back to us by Monday, the 10th of November, so that'll give us time to collate everybody's feedback, engage further with members where necessary, and thereafter submit our responses to the regulator. I need to highlight a very, very, very key point. In addition to what you send us, members should also submit their individual comments directly to the FIA through their official Microsoft Forms template. Brad, can you please show our members what that looks like? Okay. So thank you, Brad. Much appreciated. So just for a sensitizing moment for our members, the reason that we're highlighting this, and this is fundamentally important, the FIA will only accept submissions through this template. But, and this is a very big but, and please, I can't put too fine a point on this. There is no save function on this form. When you start to input your data, you will need to start and you will need to see it through to completion. If you leave the form while you're working on it, all the information that you have put into this form will be lost. So you really need, I would say, use the FIA's word template or our word template, collate all your information, and then have someone sit down for a dedicated period of time and from start to finish, complete the form. We have flagged this with the FIA. We have complained to the FIA. We have indicated that from our perspective, this is a barrier to getting people to submit, people who are busy and do not have a lot of time. But please, you really, really, really do need to submit your individual comments. We can look from an industry perspective and take into account systemic and key challenges, but we do not know what you do and don't hold in your specific business, nor can we comment for every individual member of the FIA. We will comment from a holistic perspective and highlight key areas and challenges and particularly trends that we're seeing across our membership, but really, really, really need to make your own submissions about the particular challenges being faced by your businesses. So please remember, this is the only format that the regulator will accept, and you need to do it from start to finish to get this done. And then finally, what we've done is we have created a singular channel to reach Brad and I directly called Omni feedback@fia.org.za. So if you've got any queries or comments or suggestions that you'd like to make in the interim, please do use this. As I say, we will share this with everyone when we share the recording and reshare the templates and everything that we have shared with you thus far. And we really do look forward to seeing you for session 2. And thank you so much for your time and putting in the energy and effort to be here with us today.